Okay. So good morning, everybody. Thank you for attending today's presentation. Just a couple of housekeeping things before we get started. If you could just keep yourselves on mute just as the presentation is going on, and then feel free, you're more than welcome to answer any or ask any questions that you have. Or if you feel more comfortable and want to use the chat, you can do that, and I'll watch for those questions and I'll relay them over. So I am just going to pull this up and do an introduction here. So I wanted to welcome our guest speaker today, Brea-Anna, who is from the TD Bank. So Brea-Anna has been with TD for 8 years. As an analyst, she works directly with the commercial banking team to manage their group of clients and is responsible for providing banking and financing solutions to clients in a diverse range of industries. In her free time, she enjoys spending time with her family and doing outdoor activities such as camping, hiking, and fishing. Welcome, Brea-Anna. And thanks for joining us today.
Thank you, Lori. I'm going to just attempt to share the screen here. Let us see. Are you able to see the screen now? Are you able to view the PowerPoint?
Yeah, we can see it just so you know, it's not in like PowerPoint presentation. You can see the slides on the side. I didn't know. Okay, good. Yeah, we're good to go.
There we go. Thanks. Okay, so I will jump right into it. Thanks for the introduction, Lori. Like Lori said, I've been with TD Bank for about 8 years now in commercial banking, so provide solutions to business bankers, businesses across Northern Ontario. From industries as diverse as medical, dental professionals, to construction companies, to real estate operators, manufacturers, everything in between. One of my favorite parts of my job is that I get to talk to a lot of business owners and learn about businesses in such a diverse range of industries. And I get different outlooks from a lot of different folks on what is important to them as a business owner and business professional. So today I just wanted to talk a little bit about a few things. The agenda is here. So I wanted to start off with financial planning for your business, talking a bit about capital structure, equity versus debt financing, as well as some important financial metrics that can help you when financial planning for your business and making business decisions. I also want to talk about what to expect when approaching the bank for financing, what it is that we look for when assessing a credit application, as well as matching up different types of needs that businesses have to different financial solutions available and what that looks like for business owners. I also want to chat a little bit of sources of capital beyond a bank. I'm not a specialist in any of these areas, but I know that when you put together a few different things, whether that be government assistance, sub-debt financing together with traditional financing, oftentimes those are the types of unique solutions that business owners need to help them achieve their goals. So I want to chat a little bit about how different programs can work together to help business owners. That is the agenda. If anyone has any questions on the way through, like Lori said, feel free to put them in the chat. I'd be more than happy to answer them. Or if there's anything else that you guys would like to talk about at the end, I'll leave some time for some Q&A as well. So starting at the top, I want to talk a little bit about corporate finance. So as business owners, each of you would be responsible for the corporate finance of your own business. So breaking that down into as simply as I can, you can think about the balance sheet of your business. So at the top, you would have your assets. Assets can be broken down a little bit farther into short-term assets, which would be things like cash, inventory, accounts receivable, and long-term assets, which would be buildings, equipment, things of that nature. On the other half of the balance sheet is two boxes, debt and equity. So debt can be also broken down into two sort of subcategories: short-term debt, which is things like operating lines of credits and credit cards, and long-term debt, which is leases, loans, mortgages, things that have that longer term associated with them. Also on the bottom half of the balance sheet is a company's equity. So equity is the money that you as an owner, or if an outside investor has put money into the company, it's the money invested within the company. So equity can take a few different forms. That could be traditional shares, whether that be common, preferred shares, or some type of convertible share, which is what is represented by the cash or money that an owner actually invests into the company. Or it could be what we call retained earnings, which is essentially historical profits that a company has made. So they've gone through a year, they made a profit at the end of the year, and they retain that within the company, either reinvested in assets or keep it in the company as cash. So that's what forms the equity box. So when thinking about corporate finance, I like to start with the balance sheet and break it down between the assets that a company has always being equal to the debt and the equity a company has. So that's sort of the basics in terms of, you know, making some of these, doing some of these other financial calculations that will help you make business decisions as you're looking at the finance of your individual business. So we're gonna move along here. So I wanted to compare a little bit between equity versus debt financing. It's important to consider both because deciding to either finance something via equity or finance something via debt is going to have different implications for you as a business owner on how you run your business and different obligations associated with both of those different types of financing. So just reminder, equity financing is money that you or investors are putting into the company, whereas debt would be like bank debt, other forms of lender type debt. So in terms of equity financing, there are benefits and risks, the same with debt, and I've listed some of them here. I just wanted to highlight a few of the major ones. So in terms of equity financing, the major benefit is that there's no loan to repay. There's no obligation of cash flow leaving the company to repay any debt. Other benefits could include if you're bringing in outside investors access to their business networks and contacts, as well as in the worst case scenario, if the business were to liquidate, there's no priority obligation to the bank. Equity investing is usually in junior in ranking and would be one of the last forms of being able to repay in the event that the company was liquidated. There is some major risks in terms of equity financing, especially if you're bringing in outside equity, whether that be from sort of investors or friends, maybe sources beyond the friends and family inner circle where there'd be more easier repayment terms. The main risk is dilution of ownership and control. So you decide to expand your business and take on a new partner, let's say. So you're sharing that ownership interest now with your partner. You're not the only one making decisions. You're not the only one having that operational control of your business. And when speaking to business owners, they find that sometimes when striking out into partnerships or adding investors, that loss of control can greatly impact what they can achieve in terms of the go forward strategy for their business. Something else to consider is once you bring in that partner or outside investor, that they get all of the upside ongoing, right? There's no term that they're going to be a part of that. So any profit of the company, any upside to the company moving forward, they also would get a piece of that, whether that be via dividends or any other type of payment to them. And also equity investing doesn't provide any tax shield. So I'm going to go into an example on that a little bit later here in the presentation. So in comparison, there are benefits and risks to debt financing as well. So these need to be considered when making decisions. So that way you know how those decisions would impact your business, right? So for debt financing, one of the big benefits is that you retain ownership and control. You're not bringing in anyone outside of that you now have to share ownership and control of your business with. As a shareholder, any go forward profits or any upside in the business, you get to retain that to yourself. Debt financing is tax deductible and provides somewhat of a tax shield, so that's positive. And its debt is usually for a finite term. So depending on what it is that you're financing, there's a set finite term, and when that term expires, the bank no longer has whatever interest they had related to that debt financing. That expires at the end of the term generally. In terms of risks, there is a contractual obligation. So conversely, like I said, with equity financing, there's no loan to repay. In the case of debt financing, you do have an obligation to make that monthly payment to repay that loan as per whatever the terms of the agreement were. So that is a big risk for some companies. It also can magnify losses. So if the company is not profitable and then also has an obligation to repay on top of that, that can magnify the overall loss and the overall risk involved for a company. And then another large risk is in terms of liquidation. You know, if the company has to wind down for any reason, lenders usually have senior ranking, so they would be the first one to recoup their finances, their financial position before any equity investors within the company. And there's some different sources for both equity and debt financing below. So I want to just go through a couple of what we call key performance indicators in the financial industry. These are just some calculations that you can make when looking at different options in terms of whether you want to take on any debt financing or equity financing related to whether in this example, it's a capital purchase for a company. So return on investment is a financial metric used to determine the profitability of a business expenditure. So in this example below, let's consider you're buying a business, a house or a building, a property. The total capital purchase is $100,000. That is the cost of the property. And then for the example, I just used an interest rate of 5% to hopefully keep it a bit simpler. So this first example here is if we were selling at a profit. So say down the road, 1 year down the road, you sell that house that was originally cost $100,000 for a profit. Okay, so we'll run through the equity and debt financing examples first. In the case of equity financing, you're using your cash to pay for the full $100,000 of the costs associated with buying the property. There is no debt. There is no interest or cost related to the debt. And then you sell the asset for $120,000. So your profit is $20,000 or your return on investment is 20%. So, and then you compare it to debt financing. So say you went and got debt for this purchase of the house or building, and you put down 10%, which is your down payment, but you took on debt for the other 90,000 here. So the cost of the debt, the interest rate annually would be 5,000 or 4,500 on the 90,000 in debt. And you sell the asset, which would be the house, for the same 120,000 as the other example. So your profit now is only 15,500 once you take off the repayment of debt and the cost of the debt for holding that debt for 1 year. You made 15,500. But comparatively to what you put in at the get-go being only 10,000, your return on your investment is much greater than if you had used all of your cash to make that original purchase, right? So there is some benefits in terms of return on investment for debt financing, because you can often, if your investment is profitable, you're going to get a greater return if you choose debt financing, because you have put more cash down up front to make that purchase. Now, looking at the other side, if you make an investment, similarly, you buy a house for the same amount here, and you do go through the same financing example as the previous example, but you sell at a loss. So there's a loss associated with that investment. If you finance via debt, you're going to magnify that loss, because the initial amount that you put down, it compared to what you have sold the asset for, there's a greater difference for debt financing. So when making decisions for a business, whether you want to equity finance something versus debt finance, it's really important to consider the likelihood of when you dispose of the asset, whether it's going to be at a profit or a loss, what that time period perhaps looks like, because you'd be spreading out perhaps that the profit or the loss over the entire time period. There's a few different things to consider there when striking out to make a capital purchase, and choosing perhaps what level of debt financing you want. If you put like a third example, not included here, but if you had put half of the financing down as debt versus only putting 10% down, in the case of the loss, then that you would also lessen any blow, right? So you'd have to make those considerations, knowing your business best and what that looks like moving forward for your business, what that could look like if you were to sell the asset for a profit or a loss. So, want to go through one other example as it relates to, financial planning for a business, and that would be return on equity. So just to jump back here for a second, if you think back to our first slide, you had assets equal your debt plus your equity. So debt and equity together is always equal to the assets of the company. Return on equity is essentially calculating of the profit that you make for each dollar, how much of that is your return on equity. So essentially what you do is you divide the net profit earned in any year by the value of the business's total shareholder equity. So I have an example here, and let's think of the balance sheet again. $100,000 worth of assets, $100,000 worth of debt and equity. So there's two examples. The first would be that 100,000 is held entirely in equity. So no debt on the balance sheet itself. So let's look, this is an example of the top portion here of an income statement for a business. So they ended their financial year and they made, before interest and tax, $15,000 in profit for the year, net profit, okay? They have no debt in this example. Remember, they have $100,000 of entirely equity within the business. So their pre-tax income is not deducted, but there's no interest deducted. It's $15,000. They pay their taxes and they end up with a net income of $9,700 and change. So their return on equity is that $9,750 divided by the $100,000 in equity that they had within the business, or 9.75%. That is how far each of their profit dollars go being reinvested into equity in a 100% equity example. So on the other side, if we looked at a company that had a capital structure where the assets are $100,000, $50,000 worth of debt and $50,000 worth of equity. So that means the business owner only put in half as much upfront to get that capital structure, right? And they had the same net profit for the same year, but they'd have interest expense because they have to repay that loan, the $50,000 of debt. That would be the annual interest expense on that. And then they make a pre-tax income of $12,500. So less than that of the equity example. They pay their taxes and overall they have a little bit less net income, but the return on their equity is much higher because when they look at the profit they made against only the $50,000 in equity that they had to put in, they're still making much more profit dollars compared to equity than they would in this scenario, right? So in this case, they made $8,125 compared to only the $50,000 in equity they put it up front. So a much better return for them than the $9,750 compared to the $100,000 of equity that they put up front. So, and it also reduces their tax obligation. Like I mentioned earlier, debt can act as somewhat of a tax shield because it is deducted from the interest is deducted from their pre-tax income before their tax. So just wanted to highlight, those are two really important, what we call key performance indicators. They can help make business decisions when deciding whether it is appropriate for a company to, use their own equity to make a financial purchase or consider using debt financing to make a financial purchase. So these are just a couple of the metrics that can be considered and used when helping you make those decisions. And again, each business is slightly unique and would have its own different starting point for capital structure. So that would all have to be taken into consideration when you look at your own business. I also want to say that, if you have an accountant or a bookkeeper, these financial metrics are something that they would likely be very familiar with and can help you in making those calculations and having those discussions around structuring what would be most beneficial for your business. So let's get into a little bit of our next topic. It's a little bit lighter, a few less calculations about what if the bank looks at when assessing credit requests that comes to us. So the first thing that we look at is what we call the 3 C's of credit: character, capacity, and collateral. So character is usually the first C that we'll look at. And for character, usually we consider a person's personal financial history and how they manage personal credit as a good indicator of how we would expect them to manage their business financial credit and business financial affairs as well. So a few of the things we look at would be the personal financial history of the owner, their credit bureau and bureau score. Other things that we might do if the business has some longevity or has been around for a few years is that we'll look at the financial habits of the company itself around credit, the retained earnings of the company. Have they been retaining profits within the company? We'd be looking at the historical experience of the owners as well as opinions of them in the industry, whether they have a good reputation for paying people on time, things of that nature, right? So that's usually the first C that a lender would assess. The second C a lender would assess is capacity to repay the financing being requested. So to determine this, we would look at the business's cash flow position to make sure that it can afford its debt obligations. Essentially, what we want to look and is see that the cash incoming from the business is sufficient to not only cover each dollar of debt that has to be repaid in any given time period, but as well as have a small buffer, in case of worst case scenarios. So high level rule of thumb is for every $1.2, so for every $1 of debt that needs to be repaid in any given time period, the bank wants to see $1.2 minimum of cash flow available to repay that debt. And like I said, that's just a rule of thumb. It can change from industry to industry. I'd say that's just a very broad rule of thumb. If you want to talk with your own business advisor, they'd be able to provide you with the exact calculation that would be most specific to your business and your industry. So again, just a very general and broad rule of thumb when looking at your own financials and cash flow position for your business. And then the third C is collateral. So I've strategically put collateral as the third C here because usually if there's any shortcomings in character or capacity, or if the business doesn't have as long of a track record for the banks to be able to get an adequate judgment of character and capacity, then usually a greater emphasis is being put on collateral. So collateral is things like personal financial assets, business financial assets, things that could be pledged to help support a credit request and mitigate any risks that the banks view in terms of the credit request. Generally, we get a personal net worth statement, which would provide us like an overview of what assets are available between the business and the personal side, if collateral was required. And collateral, it would depend on the type of financing being requested, what level of collateral might be required. Again, it's on a case-by-case basis, I would say, because everyone's going to have different factors for character and capacity, and as well as collateral for each of their own business. So it's not a one-size-fits-all approach. It's more of a customized approach, I would say. So what do you need when approaching the bank for financing? I mentioned it before, truthfully, banks have a harder time lending to startups and relatively new businesses. There's not as much of a track record there for us to be able to assess the 3 C's of collateral on. So generally, we need more information from startups. And it also might be reasonable to look for forms of what we call patient capital. So this might be subordinated debt or some sort of debt equity, excuse me. So different types of capital in coming to the business that outside of traditional financing. So I'm going to talk about that a little bit later on, when, like I had mentioned in the agenda, beyond the bank sources of capital, because in the startup and early phases, those are usually great sources to reach out first, and then as time goes on, can be used in a hybrid fashion with the bank to create a customized solution for businesses. So some potential sources of patient capital could be community future development corporations, BDC, the Business Development Bank of Canada, some regional and municipal small business centers provide their own house startup financing arrangements. Organizations like Perio that do the peer lending and small grants programs. Those would all be considered forms of what we call patient capital, which are usually looked at before debt financing as you're growing your business from a startup through early day phase. I'm also going to talk a little bit later, a bit more about government assistance programs, but I would say that for both, startup early businesses and existing businesses, it's really important that you leverage all of the government assistance programs out there. There's lots of contributional grants that can be accessed to, get really cheap capital for your business. So something that's important to consider and spend time looking into. So for both startups and existing businesses, a great starting place for information to provide the bank is a business plan. A few things that should be included in the business plan are: what is your business? Who is your target market? What is your marketing plan and how do you plan to get customers? Who is your competition and what is your competitive advantage in your business? We also like to know who are the business owners and what is your background and experience, specifically as it relates to what it is that your business does, right? Another very important item would be projected financial statements. So we want to see not only what the business has done historically, but what you expect the business to do. Oftentimes when you're approaching the bank for financing, it might be to help with financing a new building location, retail location, or store where you're going to display your inventory. It could be to acquire a piece of equipment that you will then use in whatever purpose it's for, and it'll turn into profit dollars at the end of the day as you use this a piece of equipment for different contracts, right? So if you're approaching the bank for financing and it's to purchase an asset that asset is going to make your business additional cash flow, it's really helpful from the bank's perspective if that's put into a form of projected financial statement, that we can see what you expect that asset to contribute to your business in terms of profit going forward, right? Oftentimes we would see financial projections that include not only what is expected, but also a best case and a worst case scenario. Things don't often transpire exactly as planned, and we understand that. But I would say it's important to look at that worst case scenario, because even in a worst case scenario, banks being conservative lenders want to know that there's still sufficient cash flow to service that debt, right? So say you would plan to purchase an asset and it was going to make you $10,000 more a year, and your loan you had to pay was $5,000 a year in annual principal and interest, right? So you have a decent sized buffer. In a worst case scenario, say that asset doesn't make you to 10,000, it only makes you 7,500. Well, is that buffer still sufficient? Does it still give you that 1.2 times cash to service $1 of debt? So in that scenario, yes, it would, but it's something to consider as well. You don't want to find yourself in a scenario where that asset that you got now can't make you enough money to service the debt, and you have to take that cash from other areas of your business that where those dollars were already being spent for other purposes, right? So something to consider when you're planning to make purchases and provide the bank with information around why you're looking to make a purchase and why you're looking to finance it, right? So on TD Small Business Tools and Resources page, there is a template business plan. I would say most financial institutions on their web pages have business financial templates for business plans and other different information. So it never hurts to take a look at your financial institution's website and see if they have set templates available to use. That's a great starting point because that's the bank's own template that they've developed. So providing all of the information in there would be helpful for them. So some other things that generally the bank will ask for when you approach them for financing is if it's an existing business, we'll want the last few years' financial statements, business registration documents or articles of incorporation, personal income verification, either by way of NOAs or pay stubs if you have outside employment other than the business that you're currently running. A personal net worth statement, which I mentioned before, which is a form that your lender will provide and includes details on your personal assets and liabilities, and as well any other information that you think would be helpful to the bank when reviewing your credit requests. You know your businesses intimately, so I feel like if you think that something else would be important or imperative for your banker to know when you approach them, feel free to include that. Usually we would like to, learn about your business as much as possible. That way we can make informed recommendations and offer informed solutions when we do look at offering you potential solutions for your business. So I alluded a little bit earlier to understanding cash flow, but I just want to focus on it a little bit more in depth. Understanding cash flow is really important when looking at different types of credit because different types of credit are going to be used to meet different types of cash flow needs. It's also really important that there's sufficient cash flow from the business required to meet the short-term and long-term obligations, which could include repaying loans or guaranteeing any financing during a period of growth for a business, right? So just wanted to put a few things out there for short-term cash flow obligations. Some important questions for a business to consider are when doing their financial planning would be, do you need to purchase inventory and then hold it for a period of time, right? Because you have that cash outflow going out, but you don't have a cash inflow coming in to match that for whatever period of time that could be. Do you pay for a product or service right away and then provide payment terms to your clients? So like lots of folks in different industries, they don't necessarily receive payment up front for a product or service. Maybe it's payment within 15 days or 30 days. So that's something that needs to be considered in terms of mismatch between timing of cash flow. Also, if there's any foreign exchange, so if you're buying your product in US dollars wholesale from the States and then reselling it in Canadian dollars in Canada, there's going to be some, not only a timing mismatch, but a currency mismatch as well there. So anytime there's a bit of a mismatch, it's really important to think about how that impacts a business's cash flow position. Also important to think about long-term cash flow obligations. So what obligations do you have to meet with those profit dollars that your business makes? Do you have annual equipment or other capital expenditure requirements that are part of your ongoing business that need to be made from those profit dollars? Will you be making them from purely your profit dollars, or what I was referring to earlier as equity financing, or will you be making it, or is there a debt obligation associated with those purchases? If there's a debt obligation, there's still going to be a loan repayment obligation and a contractual cash outflow for the business. So that's important to consider in either case. Perhaps you want to save toward a future goal, whether that be purchasing a building, acquisition of a different business or different product line, any sort of larger capital expenditure that you aspire to in the future. It's important to consider, saving cash now or creating your own sort of regular obligation out of your cash flow to save and take meaningful steps towards that next goal. Another really important aspect when doing your financial planning and cash flow planning would be to consider your own personal financial obligations and lifestyle. So as a business owner, you need to ensure that the business can provide you a sufficient salary to meet your own personal obligations. And because otherwise you have to have another source of payment, whether that be from personal savings for a period of time as your business starts up, or another form of employment outside of your main business. But it's important to consider because you still will need to meet your own personal obligations, whether that be your mortgage payment or your car payment, when planning for the cash flow of your business as well, right? So in business, I often hear the saying cash is king, and many business owners, would say that cash and understanding and managing their cash flow is very important to the success of their business. Again, so online TD has a tool, a cash flow calculator and cash flow planning tool, which can be helpful when managing the cash flow needs of your business. And there's also a variety of other sort of financial tools out there available that can help bridge some of those timing mismatches and things that I just mentioned. So we'll move through to different types of credit. So types of credit can largely broken up into short-term and long-term credit. Traditionally, lenders like to match up short-term assets with short-term credit and long-term assets with long-term credit. So short-term credit is usually used to manage short-term cash flow needs. So think about some of those questions that I just asked in terms of short-term cash flow needs. So business overdraft protection or business lines of credit, they're often referred to as operating credit. And these will be the types of credit that help you bridge those short-term cash flow mismatches. So you have to order inventory, perhaps you draw into your line of credit, and then you sit in a negative position for a month or however long it takes until you sell that the inventory at a profit, and you make that cash and get back on outside of your line of credit. So back into the black, let's say, versus the red. Other forms of operating credit would include business credit cards. So those are short-term in nature, where to bridge short-term cash flow needs. So you might not have profit dollars right now to pay for whatever that expense is. You use the business credit card temporarily. You retrieve your cash a few days later, pay off your credit card, right? So short-term in nature. And credit cards can also be used for other purchases like rewards points and things of that nature. I would just say, business credit cards are usually a more expensive form of short-term credit than business overdrafts or business lines of credit. So it's just making sure that you're managing your short-term credit needs, your short-term cash flow needs, and using those tools responsibly for your own business and financial purposes, right? So in terms of what banks look for when assessing requests for short-term credit, specifically a short-term business line of credit, let's say, or overdraft protection, banks would want to see that there is sufficient short-term assets available to cover off that short-term credit being requested. So say you're requesting a $100,000 line of credit, we would like to see historically, on average, understanding that cash flow is varied at any given point in time, but on average that there'd be enough accounts receivable, inventory, other short-term assets to provide usually at least one-to-one coverage with whatever's being requested in terms of operating credit or so line of credit or overdraft protection. We also look at the equity of the company, and we like to see that there's at least one-to-one equity compared to the operating credit being requested as well. Again, I just want to mention those are just really broad rules of thumb, not specific to all businesses and all industries, but just a broad sort of starting points in terms of what we would look at when assessing, like from a financial metric standpoint, when assessing a credit application. So let's move to long-term cash flow and long-term debt. There's different types: business leases, business loans, and then business mortgages. So depending on the asset that you're requesting that the bank finance, we would look at different terms for business loans and business leases. So say a used piece of equipment, an appropriate term amortization could be 2-3 years. A new piece of equipment could be 7 years. Some medical dental equipment could be up to 10 years. I would say on average, it's usually somewhere between 2 and 10 years. So when planning to make these purchases, it never hurts to reach out to your business advisor and your accountant. They can advise you what the likely term or amortization the bank would provide is, and then you can plan your cash flow better accordingly, right? Because you'll have a better understanding of what that repayment obligation will be over what time period relative to what that asset might do for your business, or what that profit that asset might bring in, right? Business mortgages is usually terms and amortization anywhere between 15 to 25 years. These are usually longer term assets, property and buildings. And usually the term and amortization is determined by the remaining useful life of the property itself. And we get an appraisal for that purpose. The appraisal usually provides us that detail, and then the bank utilizes the appraisal to convey what the term or amortization that they're comfortable financing the property would be for. And then so beyond types of credit, just want to say a few different words. Business owners also have a lot of other banking and financial considerations. You have to consider, how you're going to receive and deliver cash each day, make payments, pay employees, things of all of that nature. There's a whole host of electronic and non-electronic payment solutions out there to navigate those sort of day-to-day needs. There's also point of sale terminals and different online solutions and how to receive cash from customers. So I would just say broadly, don't hesitate to speak to your banker or your financial advisor on all of those things as well. Those are equally important to business owners, and those tools can also help you manage cash flow as well, right? How you're going to receive and make payments is important. So I'm going to speed up here because I feel like we're taking a bit more time than planned. I apologize, everyone. So just broadly, I want to mention, I work with a lot of businesses. I see a lot of businesses tap into these different Northern Ontario specific funding streams through the Northern Ontario Heritage Funding Corporation. And I've seen a lot of success from different businesses in achieving funding through these different programs. So highlight many of my clients that I work with, they've used this investment stream to expand existing operations in Northern Ontario. There are, in most major communities in Northern Ontario, NOHFC offices where they'll help and answer questions with regards to preparing applications. There are private firms as well, and most accounting firms have some sort of support. Of course, it costs dollars, but in terms of preparing the applications for NOHFC, to help you be successful in getting those contributional grants or loans from the NOHFC for your various projects. I've also seen a lot in the past little while, the People in Talent program. So paid internships where the NOHFC for 1 year provides partial payment for the salary of an additional worker for a business. And specifically focusing on Indigenous interns as well, where they provide a bit more generous contribution or subsidization for that individual salary. So just some things to keep in mind when thinking about your business and different things that might be upcoming, expanding, taking on additional workers. Worthwhile to spend some time looking into these programs. Oftentimes they give you a contributional grant portion, which is non-repayable, but also may offer a contributional loan portion, which is a more typical standard loan repayment. And then oftentimes NOHFC will also let you go. So loan payment interest rates through NOHFC could be higher than that of traditional bank financing. So they may let you elect to go with your day-to-day bank for the loan portion, but still provide the contributional grant portion. So you can sort of get the best of both worlds as well there. Something I'd recommend looking into. Again, I'm not going to go through all of these in detail. I just want to highlight that, there is a very wide variety of government assistance programs out there where you can tap into those contributional grant and contributional loan dollars, like right across, whether it be environmental sustainability, expanding your market, expanding your workforce, growth, expanding your existing operations or facility, or innovation, R&D, commercialization of prototypes. There is a wide range of programs and available dollars out there. It's worthwhile spending some time looking into, because these are often forms of capital that business owners can tap into, that don't require the equity out of pocket, or depending as well if it's a contributional grant, without a loan obligation related to it as well, right? So very worthwhile. One other area I want to focus and highlight is local community future development corporations. So they're a bit different from the banks, that they go more into the startup and very new business space, as well up into the medium business space. They're generally considered a form of patient capital. They often provide longer repayment terms. And they often will take a subordinated position to the bank. So if a bank cannot provide all of the financing being required, you might be able to get 75% financing from the bank, 15% financing from a community futures development corporation, and only require 10% equity out of pocket for that specific purchase, right? So they just provide some greater flexibility in terms of structure, so that way you can take that next step and move your business forward, purchase that asset. So some examples is, like I mentioned, subordinated debt, financing to shore up debt to equity ratio. So sometimes they'll provide financing right to the shareholder if the balance sheet's a little bit mismatched, where the debt is significantly more than the equity. It also helps with risk decentralization. So your bank, as a conservative lender, might not be comfortable providing you the operating financing, so that line of credit together with term lending for purchase of an asset. Oftentimes, the community future development corporations can come in and take a first position on that asset, subordinate their position on the remainder of the business itself, and allow your bank still to provide you with that day-to-day operating credit that you need to manage your short-term cash flow needs. So essentially, the bank and the community future development corporation share the risk, so that way you can get a bigger piece of the financing pie versus equity. So I just have a couple quick examples here. The first one I had already alluded to. So companies purchasing a $500,000 building. The use of that capital is $500,000 in building costs, $10,000 in legals and closings. And these are real life examples that I have seen in Northern Ontario of joint sort of sharing of risk and sharing of financing between banks and community future development corporations. So banks will generally lend up to 75% of the cost of a building purchase. There's some other variables in there, but 75% is just a rough rule of thumb. So a business owner does not have the full 25% cash equity to make a down payment for the difference. So they approach Community Future Development Corporation for 15%, and then they have cash equity for the remaining 10%. So the Community Future Development Corporation would take a second charge on the building and allow the bank to take a first charge on the building. So that way the bank, being a conservative lender, still has their security interests being met, and Community Future Development Corporation would probably charge a slight premium, so perhaps higher interest or a higher fee for setting up the $75,000 in financing, but it allows the business owner to still make this purchase, whereas perhaps previously, if they didn't have enough down payment or equity available to make us a down payment, they wouldn't otherwise be able to, just through going through a traditional lender, right? So that's just one example of a hybrid sort of financing solution that could be used to help make a purchase that otherwise couldn't. I do have a second example here. So this is the case of a business acquisition. So a business purchasing another business. So the costs, the acquisition of shares, legals, and some working capital to get started. So in total, 230. This was a case where the Community Future Development Corporation came in as the primary lender in this case. The bank lent specifically on some specific equipment based on the equipment value, which worked out to be about 25,000, and then also provided the working capital support required, so the operating line of credit or business overdraft. And by using the Community Future Development Corporation, where the bank wasn't comfortable lending on as much of the acquisition of shares because there was no tangible asset collateral there to secure the loan, the Community Future Development Corporation did not require that tangible collateral, and they were able to provide a lot more capital in the background to assist with the purchase and overall reduce the amount of equity that the owner had to have in order to make that business acquisition purchase, right? Sorry, my number there is wrong. It should be 230. I just noticed. So those are just a couple examples where you can work. It's important to look at different options when financing. And I would say talk with your business advisor, your financial advisor. They should have experience in working with different organizations, bridging, government assistance programs together with community future development corporations or subordinated patient capital type financing and traditional bank financing to hopefully come up with a solution that works well for the business itself, the industry it operates in, and it helps you achieve your goals here. Ultimately, that's what we're trying to accomplish, right? So that is it for the formal part of the presentation. I did have a couple parting thoughts I wanted to leave you with, and just some best practices I've learned from different business owners over time. So one thing is, putting in that time up front and on an ongoing basis to always, make financial planning a priority. Not just financial planning, for the day-to-day and what's expected, but also consider those worst case type scenario events. During the pandemic, we spoke to a lot of business owners, of course, and many of the folks that had planned for worst case type scenarios, supply chains break down, different things happen. They were able to pivot and change a lot more quickly than others that hadn't done some of that pre-planning homework. And they had better outcomes as a whole, right? So it's very important to plan ahead and, plan for a variety of scenarios whenever possible, and knock on wood that, worst case things don't happen, but they always could. In the same vein, always plan for a little extra buffer, that rainy day money if possible. Unexpected things always pop up. So it's always good to have a little buffer wherever you can. And one of my last recommendations would be build yourself a network of peers, of business owners that you can bounce ideas off of. Pero's done a great job in pairing different folks together to help you with that. Also create a network of business professionals. There are many financial advisors, business account managers of business out there that are happy to chat with you about your business and learn more about your business and have experience and recommendations and solutions. Accountants, lawyers, all of those folks can be, great. And you can also, oftentimes they're willing to let you tap into their business networks as well, right? So they may know other folks in the business community that can help you create solutions and provide feedback on various things. So just, don't hesitate to put yourself out there and create those business networks, because they can be very helpful as you navigate different challenges and different things as you go through business. So that's all I have. Sorry, I took a little bit more time than I wanted to. Open to questions if anyone has any. And I'm also, my contact details are on the screen here as well if you want to take them down. I'm happy if anyone wants to, email me or call me down the road. If you have anything, also happy to answer that way as well.
Yeah, well, thank you very much. So if anybody has any questions, feel free. We have a few minutes here. You could unmute yourself and ask any questions, or if you want to type anything into the chat, you can. Well, anyways, Brea-Anna's information is on the slide here, so feel free to write it down and you can connect with her. So I just wanted to say thank you, everybody, for joining us today, and thank you so much, Brea-Anna. That was a wealth of information, and really appreciated the breakdown and how thorough you were with it. So thank you so much for that. And yeah, and thanks everybody for joining us, and I wish you all a good rest of the day.
Me as well. Wish everyone a great rest of the day as well, and just want to iterate again, happy to answer any questions. Feel free to reach out anytime. More than happy to help.
Great, thank you.